2-1 advancing the declining stocks. Nice start. It's a nice start everywhere. I mean, we're up 1% in Europe. Most of Asia is closed. But I just want to emphasize, we're in a global stock rebound that's going on. Just look at the year to date. And remember, Europe's up about 1% today. So we have the S&P up 8% for the year. Germany's up 7%. Shanghai's up 5%. And remember, Shanghai is closed for this week. The Nikkei's up 4%. Even Brazil's up almost 12%. This is a global rally that just keeps rolling on. Today, it's sort of the same thing. Sectors here in the United States, consumer discretionary strong. Ralph Lauren had great numbers overall. Tech strong. Apple's leading there. Materials, industrials. And because this is a cyclical rally the last 6 weeks, consumer staples have been lagging, and they are again today. Stock prices generally have been following 2019 earnings guidance. I can't emphasize that enough. It's not so much fourth quarter. It's what they're saying about this year. Look today. It's exactly what you would think. So look at the numbers today for guidance. Estee Lauder, higher revenue guidance for 2019. Look at that, 11%. Centene, inline earnings guidance, but much higher revenue guidance. That's up. Seagate was a little disappointing on third quarter revenue guidance, but it's on the flat side. Pitney Bowes, they gave lower guidance. They cut their dividend. They raised their buyback. That's down. Church & Dwight, they have a little bit of a problem. They've got some margin pressure overall, and they were a little light as well. Church & Dwight's a good one to look at right now. We're talking classic consumer products, Arm & Hammer baking soda and Pepsodent and the water pick and all of that. Higher costs from commodities, they specifically called that out, and transportation costs. They had a 25 basis point hit to margins because of tariffs. What are they doing about this? They are raising prices. They are successful, others are not. And so you've got a little bit of a gross margin problem here that Church & Dwight exemplifies. That's one of the reasons they're down today. And this is showing out in the first quarter earnings estimates. We have a very strange situation. Look at this. First quarter earnings are only expected to be up 0.5%. Hold on, revenues are up almost 6%. Well, that's kind of strange, folks. That tells you between the top and bottom line, something's going on there. Well, that's margin compression. You're getting prices, you're getting higher prices somehow, either higher wages or higher commodity costs. Church & Dwight's a very good example of that. So here's a sign that higher costs are definitely impacting the bottom line of companies that are out there. Still, the rally rolls on. I mentioned yesterday the internals are just excellent. Every day, the advanced decline line advances nicely. We're not at the old September highs, but we're getting close. Buying interest is higher. Selling pressure is lower. The VIX has collapsed. We're at 15 on the VIX. One thing we don't have, guys, is breakouts, new highs. The one exception, and Jimmy's right on it, as always, it's Boeing. That's the only real big breakout. We've had a little bit of Lilly maybe doing a little bit better as well, but that's the big breakout, new high for Boeing.